Good afternoon, everyone, and welcome to our second webinar of the day, where we're hosted by Roland Arthur, the manager of BlackRock Smaller Companies Trust. This trust invests in quoted smaller companies in the UK. It has a broadly diversified portfolio covering a wide range of industries and themes, many of them with an international element to their revenues. Despite the international slant, companies have been discounted along with the rest of the UK. BlackRock Smaller Companies is currently trading on a discount of 15%, wider than the weighted peer group average discount and wide relative to its own history. And that, combined with these battered valuations amongst the companies in which it invests, makes it potentially an interesting time to look at the trust and hear what Roland thinks about the outlook. Your microphones are muted, but you can ask questions by using the Q&A function, which you should be able to see at the bottom of your screen. And I'll put your questions to Roland at the end of the session. So please do make use of that function. So over to you, Roland.
Yeah, good morning, good afternoon. Thank you to everyone for joining. As we said, I'm Roland Arnold. I'm the manager of the BlackRock Smaller Companies Trust. I'll quickly run through the trust and the process. But I'll try and draw reference to the question, or the subject of the day, with regards to ideas for income and growth. And I think that when we're talking about a small companies portfolio, which clearly by most small companies portfolios focus on growth investing, I'm hopeful that I can also show you that actually it's not just about the growth angle here, but actually that these are companies that are capable of providing with income, and that the trust itself is capable of being a vehicle to provide income as well. So just a reminder, I've been running money for 16 years now, 20 years of small and mid-cap experience. I'm a member of the emerging companies team at BlackRock. There are 5 of us. In total, we run about $4.5 billion of assets, of which I run about 1.5 in UK small and mid-cap equities. So if we just start with the basic principles, why SMID, why active management, and then why BlackRock on top. Let's start with why smaller companies, and there's some charts that give some more detail behind this in a moment. But the UK small and mid-cap sector over the long term has outperformed large cap by roughly 4% a year, and that's data going back to the 1960s. But more interestingly than just the overall performance of the sector itself is the fact that this is a part of the market where we can see industry-leading businesses at a much earlier stage of their development cycle, businesses that dominate niches that they operate in, businesses that sell internationally and globally. And we get to catch them at an early stage when those businesses are very focused on single product or service lines rather than becoming more diversified conglomerates that larger businesses generally start to become. Secondly, within the UK, you clearly have the high standard of corporate governance. BlackRock itself pushes corporate governance very strongly. The accounting standards, the consistent rule of law, all of those things that as investors we look to draw upon as a basis, foundations and principles of investing. And then London is an attractive market for companies to IPO because of those rules, because of the huge amount of capital that sit within the London market, and because of the wide range of investors that operate within London. Why active? Well, within small and mid, there is a massive divergence of returns. Businesses, unlike in the FTSE 100, where you very rarely see bankruptcies, businesses can go to zero in small and mid and do so on a fairly regular basis. We've seen in the news flow in the last few days how that's happened to some UK companies. And the out returns also can be very large. We see businesses regularly within the small and mid that can double or triple within a very short time period. You don't tend to see that in large cap investing. So that divergence of returns is a very good place for active management. The second thing is about risk. BlackRock has a very strong risk function that we speak to on a constant basis, so we can manage the individual risks and idiosyncrasies of the portfolio over time. But again, controlling risk for active management, very, very important. And then why BlackRock? There's a couple of reasons, but the main one being we have just amazing access to companies. So we have about 700 company meetings a year. We are, by definition, on the shareholder register of most companies, and management teams want to see us. And we have a big and wide pool of capital, and small and mid cap is still about raising money. It is a capital market. And so companies want investors who have access to pools of capital, and therefore we are an attractive owner for those companies, and therefore we get great company access. We have industry-leading risk analytics, already mentioned that. And then there are various functions that we have, whether it be corporate access or capital markets, that actually take a lot of the weight off of the investors' shoulders, which means that we can spend our time either looking at companies or dealing with speaking to clients, rather than having to do lots of the administration that comes with managing a portfolio of this size and all of the company arrangements. Let's delve into some of the process and some of the things that we try to do. We have operated this investment style and this investment process for as long as I've been at BlackRock, so 20 years. We think when we're looking at smaller company investing, there are just 5 guiding principles that we need to have. And whilst none of these are particularly revolutionary, it is amazing how quickly the investment can go wrong, how quickly share prices can fall when you start to move away from these core investment philosophies and investment processes. So first and foremost, it's about the market position. What is it about this company that means that it can lead or dominate the market that it operates in? We can draw these markets very small. They can be very niche. They don't need to be particularly broad. But it does mean that the company needs to have something that it can lead in that market. And market leadership is important because these are small companies. They don't have access to huge pools of capital. They don't have massive marketing budgets. So if they don't lead the market, then they're going to lose out to the bigger players who have better marketing budgets, who have more ability to price aggressively over the longer term because of their own capital that they have access to. So it is very important in terms of that market position. And it's either having the leading position or having something that means that we can see a way to a company getting to the point that it can dominate a market. And the important thing about market position, and we'll come to this later when we'll talk about inflation, is if you lead your market and you continue to invest in your business so you maintain that leadership, then you have pricing power. And if you have pricing power, then lots of the problems that we're seeing in the economy right now with regards to inflation and cost of goods, they're less relevant to you because you can pass that on to your end customer. The second thing is the management team. We are operating in a part of the market where the leadership of the chief executive and the executive team is really, really important. They drive the strategy of the business, but also they're responsible for the culture. And quite often, there's very few layers of decision making between the top and the bottom of a company in these parts of the market, just a very few employees. And so how a chief executive acts with his staff, how he acts with investors, how he acts with all the stakeholders of the business, that's really, really important because that culture will be felt all the way through the firm. So we're looking for management teams who have delivered in the past. We're looking for management teams who have demonstrated growth. We are looking for management teams who are entrepreneurial, who can understand their markets and shift the businesses very quickly. And again, that's something that has really sort of come through in the last couple of years. If we think of the huge impact something like COVID has had on many sectors, take Watches of Switzerland, you can see on that slide. Watches of Switzerland's management team didn't expect to start 2020 with a view to closing all of their shops in March, but that's exactly what happened to them. But they managed to shift the process, shift the sales, move more online, move more towards direct meetings through Zoom, and actually managed to finish the year with higher turnover than expected at the start of it, despite the fact that the shops were closed for a significant amount of time. And that's the importance of that entrepreneurial management team that understands the culture, understands the markets, and can shift the businesses very quickly to the changing conditions. The third thing is the track record of growth. Ultimately, we want businesses that have grown in the past, that have demonstrated an ability to meet market expectations, that have shown consistent sales growth and translated that consistent sales growth into consistent profit growth and consistent cash generation. And that cash generation leads on to the fourth criteria. We want businesses that are cash generative. We want businesses that can translate operating profits into cash flow. Because if they're not doing that, then it suggests to us that actually the operating profits are misstated. Cash very rarely tends to lie. So it's a good measure as to whether the profit that the company is stating is actually real and realistic profit. And then the fifth area is balance sheets. We want companies that are well capitalized, that have net cash or balance sheets that are close to net cash. And that's purely because that means that we know as investors that we don't have to fund their growth, that in more difficult market conditions like we're seeing right now, that those businesses are secure, that we're not worried about the balance sheet, that we're not worried about when debt's renegotiated, we're not worried about the cost of interest going up, all things that we're clearly seeing in the markets right now. So those are the 5 criteria that we operate through. And we have about 700 company meetings a year, and it's through those company meetings that we identify the companies, the 100 to 120 that sit within the portfolio, by assessing them against these criteria. This slide, I'm sure anyone who's been presented to by a small cap fund manager has seen a slide that is similar to this, and it shows the long-term compounding returns that you get through small cap investing. Now, this chart goes back to the mid-1950s, and over that time, if you'd had your metaphorical £100 to invest back in 1955, if you'd invested that in large cap, you'd have roughly £100,000 now. And if you'd invested that in small mid, you'd have roughly £800,000 right now. So it's a significant outperformance over time. But despite the size of that number, that actually only compounds out at 4% a year, such is the power of compound return. And so whilst it looks a large number over that timescale, it is the result of consistent year in, year out, small beats through small and mid versus large. And so where do those beats come from, and are they, do they have duration? Is it something we can assume can happen again in the future? It's obviously, as it says all over these slides, past performance is not necessarily a guide to the future. Well, of that 4% compound return, the vast majority of it, over 3%, comes from excess earnings growth. For a number of reasons, these businesses tend to be able to just grow their earnings more quickly. First and foremost, it's because they're more focused. They tend to capture a niche market, a niche growth opportunity through either product or service, and they are focused on those niche opportunities. They haven't diversified over time into areas that are lower growth. And so as investors, we can pick up on those areas that we like, those markets, those services that we like, and we get that excess early stage earnings growth all the way through the duration of the investment without it getting moderated by companies investing in other areas. The second thing is that they can change and adapt more quickly. It is just easier for a small company to shift the focus of the business model to react to changes in market circumstances than it is for a large company to do so. If you think about the big constituents of the FTSE 100, they're huge, they're diversified, there's many layers of decision making between the chief executive and the shop floor. Any decision takes a long time to work its way up the chain and then back down the chain to become an effective action. That doesn't happen in small and mid cap to the same extent. These businesses can shift and pivot far more quickly as they see changes in their market. And the third one's M&A. Companies within the small and mid cap universe, they tend to list because they're active. They tend to want access to the capital market. They tend to be a bit more aggressive in terms of the M&A that they go through. And those acquisitions make a bigger difference to the earnings of smaller companies than they do through large companies, just by virtue of size. And so we consistently see companies looking to raise money, utilize capital markets, go through value accretive mergers and acquisitions, and make their businesses bigger as a result. That long period of growth you saw in the previous slide, there are clearly periods of cyclicality that come within that as well. And small and mid cap tends to do badly in periods where the market is feeling more risk averse, and it tends to do better in periods where the market is feeling more risk aware and more aggressive. Now, the share prices tend to divorce themselves from the underlying performance of the companies and the earnings, and that's definitely what we're seeing in the current environment. We'll talk about the outlook later, but this is the opportunity. This goes back to the earlier point of why active investing within UK small and mid, and this is the point where active investors really can add value. Over the last 12 months, we have seen a consistent sell-off within UK small mid. And it's a sell-off that is greater than the earnings impact that we've seen from the underlying companies. Yes, there have been some profit warnings, but generally speaking, companies have traded well, they have guided the market well, and they've set their estimates at fair levels that they have either met or beaten in some cases. What's happened to share prices is a typical risk-off sentiment, almost regardless of what's happening to the earnings. And that's as investors in small mid start to reallocate away when they look at the underlying investments of their portfolio and the asset allocation. That is about retail investors selling off and moving away. That's about international investors moving away from the UK for a whole host of reasons. And so we see this over exaggeration in share prices in the same way that we did in 2008. The share price of the small and mid sector fell about 50% in 2000, which was significantly more than the earnings fall of the market. And what you can then see on this chart for 2009, 2010 is the recovery, because the reverse happens. The share prices tend to do better than the earnings recovery does because of the fact that they were oversold, and those sentiment drivers tend to start working the other way. You know, the risk aversion becomes a risk on, people step back into the sector again. The illiquidity in this sector means the share prices tend to react very strongly to a recovery in underlying earnings. And so at some point, we will be moving from this period we're in right now, where the market is very concerned about the outlook, into a period where the market feels more positive. I just want to touch on the current outlook and what we're seeing and what we're thinking, because I think this matters when we start to frame some of the discussion about where the opportunity set actually sits. You know, it's clearly no surprise or no shock to anyone that the current market is very difficult. There are a whole host of issues that have hit at the same time, which have caused a significant sell-off in asset prices this year. And actually, the year breaks down into a number of different periods. We had the early part of the year when it was all about what was happening to inflation and interest rates, and that led to many questions about the price that we should put on growth assets, or the multiple that we should put on growth assets, and that caused a sell-off at the start of the year. We then moved, as we all know, into a period of massive geopolitical instability due to Russia's action in Ukraine, that feeding through to energy prices, which further fed through to inflation, which put further pressure on central banks to raise interest rates. And these things became a circularity which caused more pressure on the equity markets. Now, some of these impacts are going to endure. There is no doubt about that. You know, the issue with energy prices is not suddenly going to get better in the next few days, weeks, or months, short of some massive change in Russia's policy. But even then, due to sanctions and everything else that's going on, I doubt we'll see a sudden reaction in energy prices. Some of the other impacts may not be quite so enduring, particularly inflation. Whilst clearly inflation is higher than we expect or higher than we hope right now, some of the year-on-year impacts will start to work their way through. And actually, as we saw from the US CPI number last week, the market is not positioned for a world where inflation starts to moderate or inflation expectations start to fall. Hence the very strong reaction we saw in the markets on Thursday and Friday post that CPI print. But I think there's other things that we need to think about here when we're looking about the outlook. You know, it's not universally bad for all sectors and for all companies. Firstly, whilst the spectre of inflation is clearly unwelcome in the market and clearly unwelcome in terms of what it's doing to interest rates, remember that we try to invest in companies that have pricing power. And if companies have pricing power, then they will pass on that inflation through to their end customers and protect their margins and profitability. And ultimately, when we're looking at earnings, inflation can be a very strong driver for those companies that have pricing power. So as long as we continue to test the investment cases of the companies that we have, and they continue to pass the pricing power question, then actually inflation can be good for the bottom line earnings of some of these companies. The second thing I think we need to think about is the baseline effects here. Remember that this is not necessarily a typical downturn or a typical recession. If we think of a typical recession, it tends to start with a period of financial excess. It tends to start with frothy markets, with too much capital. It tends to start with banks with much more stretched balance sheets, consumers with much more stretched balance sheets. And actually, it's the impact that that debt tends to have that starts to cause a slowdown. This isn't the case this time around. If you think about the shape of balance sheets post-COVID, governments took most of the debt during COVID. They bailed out consumers through the likes of the furlough scheme. They bailed out companies through the various different schemes that they offered. And actually, the financial system post the financial crisis has not been allowed to get into a state where actually it's over indebted. The capital ratios at banks are actually very strong right now. So the ability of the financial system to absorb some of this shock is much greater than it has been going into previous downturns. And the third thing is that COVID held back many industries, and the supply chains have held back many industries. We've seen order books building across a number of sectors, and firms have been unable to deliver on those order books because of logistics issues, because of China supply issues and various others. And so actually this isn't a recession where we're starting from a point of too much demand. It needs to be brought back to some sort of normal level. Actually, demand has been held back for the last couple of years. And so we're not starting from the same excess and working our way through, which I think gives us confidence in a number of sectors. And the final thing is that companies do have to react to what's going on. They do have to react to the changing cost of living. So they're going to have to invest in productivity through software and services rather than investing in labor, which is more expensive. They're going to have to invest in their supply chain because supply chain duplication is something they've all got to look at post the shortages seen during COVID. They've got to think about the position of China, which has become an unreliable partner during COVID and is now seeing issues through tech transfer and export licenses where the US and the UK are looking to hold back on certain markets through China. Big customers, big consumer groups are going to be looking at their supply chains thinking, do I want to have 100% concentration in China? So there is going to be some investment going on coming through to replicate those supply chains. So whilst the market's tough, whilst there are a number of issues out there, we don't think it's all bad. We do think there are a number of trends that could support for the next 2, 3, 5 years. And I think it's worthwhile putting the current market in context as well. On the right-hand side here, you can see the mid-cap versus large-cap. What we have seen over the last 12 months is the largest underperformance of mid-cap since 2000, since before. It's just the data from when this chart happened. And this is not necessarily about mid-cap and small-cap. This is about the strength of the UK large-cap index. This is about the weighting that it has in natural resources, the value bias that it has, the exposure that it has to the dollar. There's a huge amount of overseas earnings in the UK large-cap market. And so whilst the small and mid-cap has underperformed versus the FTSE 100 this year, we think it's more about the constituents of the FTSE 100 rather than necessarily about massive underperformance of small and mid-cap in and of itself. And you can see on the chart on the left-hand side how some of the other markets have sold off, NASDAQ leading the way in terms of falls, given the heavy tech weighting, the heavy long duration weighting that the companies there tend to have. And the UK market is seeing a huge amount of de-equitization in the last 12 to 18 months. Now, what does this actually mean in principle? For me, this is a reflection of how strong the balance sheets are of UK companies right now. We are seeing an unprecedented level of share buybacks coming from UK listed companies. And that's a factor of two things. One is the strength of their balance sheets. They have the cash to invest. And the second is what management think of their own equity. They are seeing their own equity as cheap right now. And so a good source of return for them is to use their excess cash flow, because these are at their heart very cash generative companies right now, to buy back shares at what they think are attractive levels given the long-term valuation they see for their companies. And so we expect that process to continue, that strength of balance sheet and that sort of buyback and return to be a characteristic of the market for the next 12 to 18 months. We certainly don't expect IPOs to be a characteristic of the market for the next 12 to 18 months. And you can see on the right-hand side how after some a very strong post-COVID bounce in terms of the IPO market, how actually it's faded over the last 12 months given the current market conditions. And I think it's going to be some time before we see that return. Expectations for pricing need to be readjusted in the IPO market. We're definitely not there yet. Investor sentiment has to turn more positively towards the IPO market as well. I think we're definitely not there yet either. But the UK is cheap. And the UK market has attracted a significant amount of M&A this year. On the left-hand side, you can see the activity that we've seen on a month-by-month basis in both number and value. The chart on the left-hand side is not deals that have necessarily completed. This is deals that have announced. So you can see a very strong May and June period. Now, unsurprisingly, given the recent political situation in the UK, despite the fact that there's many cheap assets here, despite the fact that the sterling is certainly compared to the dollar is very cheap and therefore again sort of doubling up on the value of UK assets. People aren't quite prepared yet to dip their toe back into the UK market given the political fallout we've seen through trusts and the recent budget and the effect that had on markets. I think what we'll see hopefully is when the budget comes later this week, we'll see a more market sensitive budget, one that settles markets and sort of restores the faith and confidence in the UK government. And I think once that's through, we will start to see an increase in M&A activity, given the valuations that we see within the UK right now. And then finally, this is just a reminder of the trust, and you can see on this slide the long-term performance going back to 2004. So obviously run by us, 5 of us, through 700 company meetings a year. It's a bias towards high-quality, cash-generative, long-term growth companies, between 100 to 120 companies in the portfolio. And the trust has a long-term progressive dividend policy. And that's one of the things I wanted to finish on. We're talking about opportunities in growth and income. In terms of the opportunities for growth, the recent market sell-off has seen a contraction in the values of a large number of UK-listed growth companies. If we think about the sort of stocks that we've got within our portfolio, the likes of Watches of Switzerland, 4Imprint, Gamma Communications, these have all seen their valuation compress over the last 12 to 18 months. If I take the likes of something like Gamma, Gamma is a business that sells into the telephony market. It has 95% of its revenue is repeat. It has a net cash balance sheet, and the rating is now 15 times earnings for a company growing its earnings at 10 to 15% a year. Watches of Switzerland similarly has seen its valuation compressed to 15 to 16 times earnings for a business that reported only a couple of days ago that it's growing revenue in the first half at 30%. These sort of valuations can't sustain at these levels if these companies keep delivering. That sort of earnings growth will be reflected in valuations and share prices over the mid to long term, provided they keep hitting those expectations. And clearly, as managers, that's our job to make sure we're investing in companies that maintain those expectations. But the income shouldn't be ignored. Companies are different now to how they were 15 to 20 years ago in terms of how they build their capital base. Much more of what they do is flexible, whether they be office space that they rent rather than buy, whether they be computing power that they rent through Amazon Web Services or through software as a service rather than spending huge amounts on licenses and IT equipment, whether that be on staff where they hire them on temporary contracts rather than permanent contracts. The cost of growth has changed for companies. No longer do they have to deploy huge amounts of capital on a specific basis for a specific project. It's much more flexible. The return on capital of these companies is much greater than it has been before, and the balance sheets of these companies tend to be stronger than they have been historically. So companies can grow at relatively low cost. Their cash flow that they get off their operating profits to conversion is subsequently much higher. That means these businesses can grow and pay dividends over time, and that dividend can grow in line with the earnings growth of the underlying company. And that matters. There's a slide in the annual report for BlackRock Smaller Companies which shows the dividends that the trust has paid going back to 2005, 2006 over time. In 2010, the average income fund was paying about 5 times what the yield that you're getting on BlackRock Smaller Companies. Now, over time, because of the earnings power of our companies and the cash flow generation of our companies, in 2019, we were paying the same as the average income fund as a yield on cost, going back historically, not spot yield, but a yield on cost. And we give them 4 times the capital return. So over time, the earnings power of these companies has accrued into cash flow, and that become dividends paid by the trust. Now, more interestingly, during COVID, the average income fund cut its dividend. We didn't. We continued to pay and grow the dividend because of the reserves that we had, but because of our confidence in these businesses to continue to generate profits post-COVID, to continue to generate cash flow out of those profits. And so we've been more dependable on our dividend stream than the average income fund has, and given greater capital growth. That is the power that these companies have. And given the sell-off that we see in the market, given the indiscriminate sell-off in share prices regardless of the earnings that have been delivered by these companies, given the strong balance sheets of these companies that mean that they can go out and carry out earnings accretive M&A, we feel just as confident, if not more confident, in the outlook for these companies than we have done for some time, and the valuation basis of these companies we have done in some time. So we think there's huge opportunities out there for growth investors, but actually we also think that the opportunity for growth investors is also an opportunity for income investors. And that's it. I'll pass you back for Q&A.
Bang on time. Roland, well done. Literally got ahead of me. We've got a variety of questions from different angles, but one question, a diligent viewer has spotted that you've got some very small holdings in the portfolio. And at the end of September, for example, Rotork was 0.1% of the trust. Obviously, that's quite small to make an impression on performance. Maybe you could talk about the shape of the portfolio, and obviously,
So there's a couple of points there. I mean, the first one, when you look at a fact sheet at any point in time, there's always going to be those holdings that are 0.1, 0.2 of the portfolio. Now, the vast majority of the time, that is going to reflect the fact that we're either buying into or selling out of a position, and that's just a report that's been cut at a point in time that shows what the position is on that day. So that's the first thing. I think it is important, though, to highlight that as an investment trust, we can do something that the open-ended funds can't necessarily do in small cap, and that is move much further down the market cap spectrum in the full and certain knowledge that the fund's not going to receive outflow. That means that we'll be caught in a position where that illiquidity is a problem for us. And so we do have positions that are 25, 30 basis points in companies that are lower market caps, sort of the 75 million plus end of the market, with a view that we believe that many of those businesses can be significantly larger over time. It may be that we think they're going to be, conducting some M&A, so there'll be an opportunity to invest more through capital markets. It may simply be it's just a very interesting earlier stage company that meets our criteria that we feel we want to have a holding in and watch it develop over time. Now, clearly, those positions tend to be more speculative. They don't all work. But it has historically been a very good source of return for the trust in terms of identifying those businesses that become significantly larger parts of the portfolio over time.
And if you were very, very excited about a company that maybe you hold in the past or whatever, what sort of size would you have as a purchase amount, and what percentage of the NAV would you let that run up to?
Yeah, so there's a couple of things. Every position we assess against those 5 criteria. Now, there are some other things that sit when we're looking at position sizing. There are some other criteria that have to come into it. What sort of market does it operate in? Is the market itself volatile or cyclical? What's the underlying liquidity of the company? It can be a very large market cap with terrible liquidity because of the ownership structure. There's a lot of other factors that go into building that position size. Now, typically speaking, we will start a smaller company that we don't know as well at a 0.5% position of the portfolio. But if it's something that we've known historically, something we really like, and there's been a liquidity event, it could become 1, 2. It just depends on those individual circumstances. We tend to max out at 3%. I think much above a 3% weighting, you become overexposed to a particular stock. And whilst we all love our growth companies and we all think that we've identified companies that can grow over the mid to long term, we shouldn't forget that this is small cap investing, and these are earlier stage nascent companies, and things can change. Things can change in their markets, things can change in their industries, things can change in their supply chains. There's all sorts of things that can cause profit warnings. So if you have more than 3%, we tend to worry that actually if any of those companies do have an issue, that you can gain or lose in a year's performance by being overexposed. And so we tend to find that 3% is the sort of point where we have enough interest in the economic upside without taking the risk of the portfolio too far.
Nice, thank you. What is your current level of gearing, and do you envisage this changing over the next few months with obviously your crystal ball?
Yeah, so it definitely will change. It's definitely not going to be the same in 6 to 12 months' time. We can make a guess which direction it will be going in. We're currently relatively ungeared. We have over the last 6 to 12 months, we have been reducing the number of holdings, taking some of the earlier stage companies out, taking some of the risk out of the portfolio, given the uncertainty and market conditions that we're seeing, and we haven't necessarily redeployed all of that capital. Partly because I did think there would be more M&A and there'll be more going on for capital markets, so I'd assumed I would be using some of the money for that. But clearly, the market's been far too difficult for that, and so we have a significant amount of firepower to redeploy. I would expect from here, if we're looking 6 to 9 months into the future, that we'll be geared again. because I do believe that we are starting to see some significant opportunities in share prices, and we'll be looking to deploy that capital to take advantage of those.
Thank you. Another related question is the old debentures, 15 million quid worth of debentures matured in July, and I just wondered if you'd replace that with a flexible facility, or whether there was, ideally, I suppose you borrowed a loan fixed at 0.1% or something, but I suspect.
Well, I mean, I'm delighted to say, and this is something the board has done an incredible job on. We do have, our gearing goes out to 2048, and we are paying very low interest on those securities, because they were all signed in the most recent, in the last 2 or 3 years. So actually, we've got very long-dated, very low-cost structural gearing, and the gearing that we've got right now is sufficient for what we need. So there's no issue with facilities.
Great. Well, another question which may be related, and again, the questioner hasn't asked whether it's NAV or share price volatility, but his question is, and I don't know whether this is true, so you may know. Why is the trust's volatility increased significantly relative to peers in 2022? Previously, it was in the second quartile between 2017 to 2021. And again, obviously, I think probably it's only fair to talk about the NAV volatility, because you're not really in charge of the share price volatility.
No. When we're talking NAV volatility, I suppose we can break this down in a number of different ways, and I'm not entirely sure which direction the question is focused on. First and foremost, the volatility of the underlying small cap market has been much greater for the last 2 or 3 years than we've seen for a long period of time. If we think about, we've had COVID, the post-COVID recovery, a huge change in fiscal and monetary dynamics, and we've got a war. All of those have led to significant volatility in the underlying markets, which has led to volatility in the NAV. And clearly, from a share price point of view, we then have the underlying liquidity of the trust itself to incorporate within that number. So those two things have led to that volatility. If we're talking about performance volatility compared to the peer group, it poses a couple of things. It depends which peer group we are drawing to. There are essentially 5 trusts that make up the vast bulk of UK small and mid-cap investment trusts, and that performance is not very different compared to, apart from one which is very value orientated, but compared to the other growth ones. The final thing to say is that we had a difficult COVID. The reopening, obviously too early on the reopening trade, which meant that we had a very difficult Q3 2020. So could be referring to that as well, if that is a reference.
Well, again, it's hard looking at without looking at the stats, but a couple of, well, there's a few, clearly some buy the dippers out here. They're wondering, not that you've got a crystal ball, but maybe more in theory then, if the UK enters or formally enters a recession, do you see this as an opportunity for smaller companies, or would you be more cautious on certain sectors, or is it a decision for each holding?
Right, it's a decision for each holding. Ultimately, the whole point of having active management, having a market that is as wide as our opportunity set is 1,000 companies, of which we're choosing 100 to 120. So it's all about assessing the opportunity set that we see in front of us and the style of companies. I'm always cautious about getting sort of sucked into discussions about market dynamics and value over growth and various other things. I think demonstrably over time, when you're looking at small and mid-cap investing in growth has been the area you want to be. And it's just, if we think about it, it's just, why would you not? If you are taking the illiquidity of small and mid-cap, if you're taking the risk that comes with investing in this part of the market, then you want growth to come out of it. You don't want businesses that are the same size in 10 years' time as they are now and picking up a dividend. You're far better doing that in the mega caps within the FTSE 100. Small cap is about investing in businesses that become significantly larger in 5 to 10 years' time than they are today. And so a recession, it's just a rebasing of the start of that growth point. And so as long as you are still sure that the operating and business models of these companies are going to be as relevant in 3 to 5 years' time as you are today, as long as you're sure that they have pricing power and that they continue to invest in their products through R&D or acquisition to maintain that pricing power and maintain that market leadership, then anything that leads to a sell-off in share prices is by definition an opportunity for the mid to long term. So, that's the first thing that I would say. Now, the timing of that, who knows? But what we do know is that share prices are significantly lower today than they were this time last year, as a for instance. The second thing, and the bit that everyone is trying to work out right now, is what recession are we actually going to face? I sort of alluded to this probably quite badly during the presentation, but they break down the market into consumer-related stocks and corporate spend industrial-type stocks. They've got two very different outlooks. The consumer is in a challenged place. The cost of living is going up and going up markedly. We know from the announcements at the weekend, tax is about to go up. Maybe some of the support is about to be dropped by the government this week. So the consumer is not suddenly going to get any better. But that is reflected in a lot of consumer-related share prices. There is a very tough outlook in the multiples that we are looking at and the expectations that are in front of us. And some of those businesses will continue to grow market share. They will continue to develop their markets. They're not all going to fall by the wayside. They're not all caught between the jaws of falling revenue and rising costs. There's clearly going to be some opportunities in those sectors. And then with the industrial sector as a catch-all, I think it is important to remember that we're not starting from this massive over-invested position that we do in typical recessions. We're starting from a place where demand has been constrained by supply, which has been held back by COVID and various other issues. And so actually many of these businesses are not going to see the fall off that they've seen in historic cycles, and yet share prices in some cases are telling you that is exactly what's going to happen. So again, there are going to be opportunities there. So you have to pick and choose. But I think you can't necessarily use history as a guide on this. We have to think about the fact that the starting point is actually quite different this time round. And actually the finish could be quite different this time around as well.
Always makes me a bit nervous. This time it's different, but
yeah.
All right, Roland. Just in terms of your sector exposure, and I know you don't pick stocks based on their sector, but have there been any sort of trends over the last 12 months? Show?
No, I think other than the obvious, we came into 2020 on the back of sort of go back in time, it feels so long ago, but on the back of a very strong Tory election win. We did think that was going to be a good outlook for the consumers. We came into 2020 with the highest consumer weight we'd had in many years, certainly since 2016 and the original Brexit vote. And of course, consumer was the wrong place to be at the start of 2020 as the whole world locked down. And so that position was cut and moderated to some extent. Now, we still have a relatively sizable consumer exposure, but it's through stocks. We mentioned Watches of Switzerland. CVS Group is another example of one that sits within there in terms of veterinary practice. But there is some of the consumer weight. But generally speaking, we are underweight the consumer sectors in their totality, whether that be through kind of house building, construction, building services related stocks, whether that be through general retail or travel and leisure. It's just the outlook for those as a sector is quite challenged. Now, we do believe there are stocks that can buck the trends within that, but generally speaking, that's a sector we struggle with. On the flip side, we do see two areas where we think there's going to be some strength. One is reflective of the fact that labour has become much more expensive. And so finally in the UK, we are going to have to start investing in productivity. We can't rely on the fact that there's just this cheap labour coming in to fill the void and to plug the growth, whether that be labour that was coming in from Europe or whether that be domestic labour, much of which has disappeared during COVID, either through people retiring, people going to university, or people going back to Europe. So companies are going to have to invest through software, through products, through whatever else it may be. So we see there's definitely going to be some spend there. And then the industrial cycle, for a number of reasons, we think there's some positive signs there, particularly this whole idea that supply chains need to be replicated. We are seeing significant investment in terms of nearshoring or reshoring. as companies look to diversify and duplicate their supply chains away from China, and to learn the lessons of what happened during COVID and that disruption. And we think that is something that could be an enduring trend for a number of years.
Great, thank you. Final question, because we're running up against time. I'm sure you answer this 100 times a year, or maybe even a month, but what are the key differences between BlackRock Smallers and BlackRock Throgmorton? One keen-eyed observer spotted that 5 out of the top 10 holdings currently are similar, but maybe you could just quickly run over the differences without dissing your colleague.
I can't diss him too much. He's also my boss. The similarities, if you saw one of the Throgmorton decks, you would see a very similar process in terms of stock selection, in terms of the characteristics that we look to identify, the sort of stocks that we look to buy. It's the same thing across our entire suite of portfolios, whether it be smaller companies, special situations, the investment trust, the hedge funds. We do exactly the same thing in terms of bottom-up stock picking through these lenses to identify the companies. The difference is in how we operate the structures, as it were. So Throgmorton is less in small cap, more in mid cap. It has an element that is international, so it can go 15% overseas, and it has a bit more concentration in its positions. It has fewer holdings in the long side of the portfolio. It also manages its gearing differently. So BlackRock Smaller Companies has structural gearing through debentures that sits, as I say, some of them until 2048, I think is the longest dated one. Whereas Throgmorton uses a long-short portfolio to allow it to be geared either long to the market or to go slightly, to bring down the gearing, go slightly short. And so that's how it has its gearing structure. So it's a different structure to the two portfolios. So Throg is slightly more concentrated, slightly further up the market cap spectrum, different gearing profile.
Fabulous. Roland, thank you so much on behalf of everyone who's dialed in, and thank you also everyone who asked a question. We've had some good high quality ones, and clearly a lot of people have done some research ahead of time, so keeping Roland on his toes. Thank you so much for everyone for dialing in, and thank you once again, Roland, for the very interesting presentation.
Thank you very much.